Having identified the various risks and ways of classifying the variables and exposures, we will now go briefly through some of the major variables to look at what kind of variation we may expect and also the significance of what we may expect into the future. This is not going to be looking at forecasting as such, but rather introducing the question of what kind of variation we need to be wary of when investigating the future. The innate risk of real estate property investment is actually relatively small. This is because it's very difficult to destroy property, especially the land underneath a property. It might be possible for a bad tenant to smash your windows, but it's very difficult to take away the basic block of land. And so overall, land is quite durable. Also, the community tends to only change very gradually. And while we've just been talking about major changes such as freeways bypassing a service station site and so on, most of these tend to have a fair degree of warning. And overall, for most properties, not relying specifically on a particular aspect of the community layout, changes are very, very gentle and gradual. And overall, as long as a community exists, there is a demand for its real estate. We see this even in older and less desirable parts of inner city areas, where in recent times the demand for these areas has been reinvigorated by the whole process of gentrification. Gentrification itself relies on the realization that you simply can't move real estate away. And even though a particular land use may depress values for a time, the underlying attractiveness of location, say in terms of convenience to a CBD, never goes away. And the gentrified areas are really testament to this. This durability of property as an investment has given rise to it becoming the most attractive asset for banks to lend against. The overwhelming majority of bank lending is lent against real estate. This is so strong that in the United States it's considered that their currency is actually backed in terms of its quality by real estate. No longer gold in Fort Knox, but rather all of the houses that US banks lend to. At this point in history, the United States residential market is not looking like a very solid backing for your real estate, and this is actually reflected in the way that the currency has had difficulties. This great benefit of real estate, unfortunately, also creates a risk exposure. This is because the ease with which debt funds are able to be obtained for real estate and the way that debt funds usually improve investment performance tends to have developed a culture of high-level borrowing against real estate. The use of high leverage inevitably increases financial and market exposure. And this is something which, again, is currently an issue in the United States, but is also not far from the headlines in other countries, including Australia. So the advantages of high leverage is that they increase the prospects of financial gain in the good times, and they multiply your ability to make investments. However, if the economy turns against you, it also increases the financial risks and the likelihood of failure, to the extent that most people who find themselves bankrupt are not bankrupt because of the operations of their business, but rather because of the demands, the burdens of their debt overheads when they found themselves too highly leveraged. By contrast, a high equity strategy tends to quarantine the risk rate exposure. Simply, if you don't borrow money, you don't care what interest rates the banks are charging. And so interest rates hikes will not affect you. But more than this, other risks and uncertainties also become less important. If I'm a property developer who owes the bank most of the value of my property development, and I find that I can't sell it as quickly as I would like, I will soon get swallowed up by the escalating mountain of interest obligations that are hanging over my development. However, if I've used equity funds, say my own funds, to do my development, and my sales are delayed, while it may dilute my rate of profit, there is no way I will actually make a loss, assuming that the property eventually does sell for my anticipated prices. And so sales delays do not affect a high equity capital structure, but they do have an impact on a highly debt-leveraged capital structure. And so your high equity strategy reduces your downside exposure, while it simultaneously reduces the upside exposure or possibility of additional profits simply due to the positive leverage effect. We find that in practice, it's only when economies are faltering at that difficult part of the economic cycle where prices are uncertain and perhaps business and employment are uncertain, that it's likely that these risks will be realised due to high leveraging. For the rest of the time, the use of large amounts of debt funds have been believed to be generally prudent business. And this means that we need to have a special attention to an understanding of where interest rates are going, because most property investors do use large amounts of debt finance. A second major variable that needs to be considered is the long-term pattern of rental values. As buildings age, it is generally believed that rents will fall. However, at the same time, or over the same time, the land value underneath the building will tend to appreciate. And it is the appreciation of the underlying land asset that tends to carry the long-term direction of rents and values. What this means is that while the building is aging, the rents may be growing. However, the capital value will be falling. This means that overall yields will tend to grow modestly as a building ages. And while it may appear that an old building is able to support a higher rate of return, it must be remembered that the old building is also likely to have higher maintenance costs and a higher likelihood of overall obsolescence, leading to the need for major capital expenditure in the future. The graph shown on this slide compares the rents applicable to land and the building, and then connected to the entire property. We can see that while the land rent is growing, that's the light green line, the rent applicable to the building, simply as the building is falling off, as the building becomes close to the end of its life. You sum those together and you find that the rent on the property as a whole is relatively stagnant. However, the overall yield, which is the very pale blue line, grows through the life of the building. This tendency of net yields to grow over the life of a building is very important, especially when we're looking at estimating the notional future sale at the end of the DCF period. Historically, it has been found that rents do not follow the same pattern of escalation that's found in property values or capital values. Rents tend to grow gently over a long period of time, whereas capital values tend to be more cyclical. This means that when you have a property boom, often the rents fall behind the capital values. That is, yields fall. Whereas when you have a major economic correction, while the capital values may stagnate or even fall significantly, the rents will tend to continue, albeit with greater vacancy rates. Rents, on the other hand, tend to be affected by the economic cycle because they're affected by tenants. They're also affected by construction. This means that vacancy can be highly variable and also can operate on a different cycle to the cycle of rents or capital values. Landlords are always very reluctant to lease properties on lower rents than have been previously achieved. And for this reason, it becomes difficult in difficult economic times for landlords to find tenants without finding some other way of implicitly reducing the rents. A practice which has come into the property market is the practice of providing what's known as leasing incentives. These include things like rent-free periods, which may be 6 or 12 months, rent-free on a 3 or 5 year lease. That really equates to a 20 or 30% discount. However, the face rent still appears to be comparable with what was previously achievable in the market. A second form of leasing incentives are fit-out costs. These are costs which may look like either expenses or capital expenditure on the part of the landlord, but are in fact benefits being given to the tenant as an enticement to have them move into a property. Again, they really consist of expenses that the tenant would normally bear, and so they become a hidden form of rent reduction. This has become a problem for valuers because the level of lease incentives is often hard to estimate because they don't necessarily find themselves expressed in the lease documents. What can be said, however, is that there is a significant variation in rents, especially over the economic cycle, and these variations can be both in terms of increases in rents but also in terms of falls. Fortunately, rents tend not to have the same degree of cyclical change that you find with capital values, making them a little easier to forecast. We can also look to the nature of leases when estimating rents into the future. Property managers and property professionals generally should be prepared to take great care in analysing leases, because the way that rents will change over time can have quite a bearing on the overall value of the lease contract. Behind the particular leases, we need to have a basic understanding of the origin of rents. There are a number of factors that influence rental growth. The most important is that rents are a function of population growth and economic strength. And we can look at these two closely related factors as the most important indicators. While often property and other business people talk in terms of supply and demand, those notions are relatively empty as explanations of change, whereas in the case of rent, population growth is certainly the most important. If a population is growing strongly in a town or a city or an area, then we can be quite confident that rents will follow and grow. Whereas if population is stagnating, or worse, if it's falling, then there will be negligible population growth. The best example of this is in the instance of ghost towns that may, perhaps during the gold rush of the 1850s, have been thriving cities where values would have been quite high. Today, no one's there, and the values are really comparable to farming land. The second variable which influences rent is economic strength. This can be simply in terms of employment opportunities, but it also can be in terms of the overall economic dynamism of an area. This means that the property economist needs to be looking to areas where populations are growing, but also where the local economy is also strengthening. This was one of the dangers of southeast Queensland for some time, where rents and property values were rising on the back of population growth. However, the lack of underlying employment and industrial opportunities meant that the long-term prospects were considerably less robust. As we move into the 21st century, it's important to be aware of these twin factors because it appears that in many ways long-term historical trends may not be being produced into the future. Australia's population, depending on the area and the forecast, may be starting to fall as close as 2050. Certainly many regional areas of Australia are already experiencing significant population falls. And while the population of regional Australia tends to be moving to the coast and to the major cities, it may be the case that even the major cities may stagnate before the end of this century. Likewise, our economic strength as a country is very important. Largely you will find that towns and cities that have strong economic hinterlands, such as effective and profitable farming lands, manufacturing or mining, tend to be places where real estate is strongest. We see this in Rockhampton and other areas that are close to mining centres. Generally, Perth and Adelaide have been seen as the most strongly performing capital cities over the last decade or two, largely on the back of the strong mining industries in the states that those capital cities serve. This means that the property economist needs to always be watching for changes in the economic outlook and population prospects of localities and areas in which they're interested. Closely related to the matter of leverage is the question of interest rates. And adjacent to interest rates is the matter of inflation. It turns out that inflation and interest rates are at least conceptually related, even though they relate to very different things in the marketplace. First of all, we'll look at variation in inflation. In our model, inflation only affects maintenance costs, and so it's not going to be one of the more important variables when it comes to risk analysis. Looking historically, we can see that over the last century or so, inflation has ranged somewhere between about 0 up to about 10% per annum. However, also when we look, there have been periods of deflation, in other words, periods when prices have actually fallen, and that can be with spikes of 5, 10 or even 15%. The important other aspect of historical inflation rates is to notice that most of the time the high rates, whether positive or negative, are relatively short-lived. We'll be exploring this later on when we look at forecasting. However, for the present, what we can say is that given that the Reserve Bank has a policy of containing inflation to around no more than 3%, and this seems to be the level of inflation that has been happening over the last decade or two, we can probably be confident that unless there is major economic upset, this kind of level will be what will be happening into the future. However, we still should consider modelling inflation somewhere between about 0 and perhaps 5 or 6%. Interest rates are a little different. Historically, they have been very constant, around 5 to 6%, way back to about a century ago. However, in the period between 1970 and the early 90s, interest rates did go through a period of more or less 20 to 25 years of rather elevated levels. Whether or not the community is able to sustain these kind of levels again is quite debatable. However, it does leave us with the question of what kind of a range we should look at for interest rates. It's likely that a range of somewhere between 5 to 15% is not unreasonable. However, you should be aware that there are some developed countries today where interest rates are considerably outside this range, surprisingly enough on the low side. Generally, we can say that they're unlikely to rise without major economic problems, but also, if they fall, it will be a symptom of large economic imbalances. We've mentioned that the investor controls leverage, but they do not control the interest rate, and so it's very important to apply prudence, especially the self-restraint, not to borrow too much. If we move now to other outgoings or expenses, we can see that things like insurance, utilities and maintenance are relatively stable. We seldom find insurance costs changing rapidly, although it has happened in the past. Another aspect of these expenses is that they're tax deductible, and this means that their impact tends to be diluted in situations where we are considering taxation in our discounted cash flow analysis. The escalation rates applicable to expenses need to be carefully considered. For our purposes, we're considering that maintenance escalates with inflation. In other modelling that you may do in professional life, you may find that the building price index or some other price index might be considered to be a more appropriate escalator. The building price index can be taken from quantity surveying manuals such as Cordell's or Rawlinson's. The Australian Bureau of Statistics issues a number of indexes for specific industries and types of products. However, the increase in precision that comes from using these should be also considered, depending on how much time you want to apply to getting exactly the right escalator. It may not really be worth the effort, but it takes a certain amount of experience to know when to apply the effort and when not to. Most property investment, and certainly property development, takes into account the fact that there will be unsystematic, completely unforeseen events that may happen. This is particularly the case with development, where there are construction risks such as, say, weather, which are quite difficult to budget and predict. And so often there will be a general allowance or a contingency made in the model. While contingencies are a common element in development cash flow analysis, you tend to find them less commonly found in DCFs for investment appraisal. This is largely because your contingency is likely to be able to be expressed in terms of maintenance or other allowances. The only other parameter in our discounted cash flow analysis is the discount rate. We've already mentioned that this is a peculiar rate because it's debatable whether it's one which comes from the market or whether it's an internal variable that is set by the investor themselves. Overall, the discount rate must be considered to be at least partly subjective because it is dependent on the preferences of the investor. However, that preference is taken from the market, and so it's partially market related as well. We normally understand the discount rate to be the return on comparable competing investments. This could be other property investments or perhaps other investments that have a similar risk profile. This means that if we're going to compare property against the share market, we would have to be confident that the share market has a similar risk profile to the property market. To complicate this even further, we have to look at the question of how debt leverage increases the risk of our property investment, again making comparison with the share market even more difficult. There are several sources of the discount rate, and you'll find in various texts a number of different standard approaches. We'll go through them briefly. The first is to look at the weighted average cost of capital. This approach is very useful when we're developing DCF models for corporations, where the corporation has a capital structure. That is, they get their money from a variety of sources, including equity or shares, and debt, such as various forms of loans, debentures, and so on. If we allocate expected returns to each source of capital, we're able to then work out a weighted average of those costs of capital. And that weighted average cost of capital becomes the hurdle rate, the discount rate, that any project taken on by the corporation must be able to achieve in order to make adequate return to be able to fulfill the corporation's obligations to its various sources of funds. Usually the weighted average cost of capital is used as a base to which a risk premium is added, a margin, and so it will be normal for investments made by a particular organisation to be perhaps half a percentage point, or usually more, above the weighted average cost of capital barely evaluated from their balance sheet. A second source of the discount rate is from the capital asset pricing model. We'll be looking at the capital asset pricing model in a separate class, but for now it's sufficient to describe the capital asset pricing model as a theoretical model that connects various forms of investment with different risks and the appropriate returns that should be expected from those different investments. What this would suggest is that if the capital asset pricing model is valid, then an investor would be indifferent between investing in fixed interests such as bonds, debentures and government bonds, which are low risk but also low return, and perhaps more adventurous investments such as high risk, high return speculative investments. On this basis, the investor would be totally indifferent. In practice, we find that there is a fair bit of psychology associated with investor behaviour, and so that some investors will tend to be very risk adverse and very reluctant to invest in a way which might incur a loss, whereas others are willing to accept these risks and effectively bet on the possibility of very high returns. Somewhere along the capital asset pricing model continuum, property exists, depending on which form of property investment we're looking at, what kind of a property we're selecting, whether it's young or old, and so on, and also the level of debt which is being used to purchase the property. And from all these, and an understanding of the risk-return profile available in the capital asset pricing model, you can develop an appropriate discount rate. The third common source of discount rate is simply from the market. What are other investors in this particular type of investment expecting? Sometimes that is difficult to ascertain directly, although in the commercial property market area it's becoming more common for discount rates to be noted in market analysis of comparable properties and their publication in the property periodicals. Overall, all sources of discount rates do come down to a degree of market knowledge and subjective adjustments of perceptions, whether it be the weighted average cost of capital, the overall risk return of the CAPM model, or whether it's simply by looking at other property investors and reverse engineering what other properties, what comparable properties have sold for. Unfortunately, it's difficult to give a convenient and precise description and method for setting the discount rate. This is because it is ultimately a fairly subjective rate. However, it's also an extremely important variable, and we'll be looking at this as we examine changes in values of the different variables on the NPV outcome. Of all the variables, the discount rate perhaps is the one variable that has the greatest impact on the result. And so we need to treat it very, very carefully, even though it is a difficult one to estimate. Generally, we can look to an understanding of comparable rates of return to at least give us an initial expectation of discount rates. At the lower level, the return on government bonds is probably an absolute floor to discount rates. You would not buy property if you are able to get a similar return by simply buying government bonds. There's absolutely no risk, or an absolute minimum of risk with government bonds. And so, say 5% is probably an absolute lower level for discount rate. In practice, something considerably higher, say 8 or 10%, is probably a more reasonable lower end. In terms of the upper end, well, that depends on the type of project. If we look at internal rates of return that are achievable for property development, we find that they're commonly in the area of about 16 to about 35% IRRs. And so if our property investment resembles the kind of risk profile in the development industry, we could see ourselves adopting discount rates of anything up to discount rates in the low 30s. Although at this level you would be expecting to be carrying a fair bit of risk. The holding period, or number of years owned, is also an important variable. The holding period is very important in the eventual net present value output. And if net present value gives you the value of the property, what it means is that this investor-controlled variable actually has an impact on the apparent valuation using a DCF approach. Developing an experience with the impact of holding period on net present value is something that is very useful for students to develop some kind of experience with. If we look at our model, I would recommend modelling between a minimum of, say, 3 years, although students are welcome to try holding periods down to 1 or 2 years, but realistically 3 would be the minimum for any serious investment being modelled. The API standard is for a 10-year DCF analysis period. On the other hand, many analysts use the estimate of building life, which is generally taken to be about 40 years, as the holding period for property appraisal. Certainly looking at major facilities such as retailing centres, office blocks and retirement villages, 40 years is becoming quite common. This of course means that your model has to go up to 41 years to be able to capitalise the notional end sale value, of course. This gives you a span of possibilities. Students do not have to run this entire span, and you may want to, say, work between 5 and 25 years or something like that. However, you'll find that if your equations are well developed, then it really becomes immaterial what holding period you consider, because it's relatively easy to expand the models to almost any amount. You should be aware, though, that the further out in time your model goes, the more precarious your forecasts are. It's very difficult to forecast anything more than a few years into the future, and to be thinking about a DCF, say, running over the next century. It is really only an academic exercise, because we have no idea of what the economy is going to look like in the year 2100. When you are considering holding period, a useful additional dependent variable to consider is the annual equivalent net present value. Definitions of annual equivalent net present value can be found in most financial management textbooks. It is basically the net present value divided by the holding period, and it really means the contribution per year to net present value. In particular, better students may want to graph the annual equivalent net present value over changes in holding period. because in some cases investments can exhibit rather strange patterns over time, which would suggest that the annual equivalent net present value can often tend to decrease for longer periods of ownership, to the point where more regular turnover of properties may in fact be called for. However, particular cases vary widely, and so it's important for students not to take any particular pattern of long-term annual equivalent net present values without actually doing the modelling for the particular case.